Welcome back to the portfolio, everyone. And today I'm giving you 5 different ETF options you can buy during a recession that will hopefully have a nice recovery and make you a lot of money moving forward. So as always, we get started by jumping right into the portfolio. And as you can see here, we have a value of $31,730. On the one-day gain, the market just opened for the day, sitting at a nice gain of $400 on the day, or 1.4%. And overall, the portfolio is down just over 5% and about a 14.5% drop in portfolio value. As well as if you look at the portfolio 1-year chart, you can see we had this sharp decline in the market where we saw not only my portfolio but the overall market drop around 30%. And then we've slowly starting to see a little recovery, and as you can see here, it's starting to look like a V-shaped recovery. Will we continue to see that recovery? Who knows? We don't know how the market's going to perform over the next month, 6 months, or a year, but it'll be very interesting to follow the portfolio and see what happens moving forward. So we're going to move on and jump right into the 5 different ETFs. So I'm giving you 5 different ETF options that you may want to pick up and buy during a recession when the prices may be a bit lower. These may give you some safety and some security during the recession, but they also may provide a nice recovery moving forward after the market chooses to recover. The first ETF here we have is Vanguard's Information Technology ETF, VGT, currently at a price of $232. Right here, if you look at the 5-year chart, it has a nice solid growth. The price has actually doubled in the 5-year chart. And as well, with this nice growth, it offers a 1.32% dividend yield. And why I like this is a technology ETF. So of course, if we move over to the holdings, 86% technology, 10% financials, so it's mainly a technology ETF. And if we look into the top 10 holdings here, they're all recognizable names. The technology industry has been booming over the last 8 to 10 years. And of course, these technology companies are some of the largest companies on the S&P 500. That being Apple, Microsoft, Visa, MasterCard. These are some everyday names that everyone uses, and they have strong growth with very small dividends right now, but all of these companies have payout ratios between 20 to 40%. So there's a lot of room for their dividend moving forward. And this is not a dividend play. This is more of a growth play. You're buying these solid technology companies that I believe will continue to survive and grow moving forward. As you can see here, Apple, Microsoft, Visa, MasterCard, Intel, Cisco. These are all very important companies in our world today. These are all very big companies, very large companies who have strong cash reserves, great balance sheets that will be able to survive this recession and hopefully thrive moving forward. So if you were to add this during a recession, when these technology companies are on a dip, I think now would be the best time. Of course, this is no recommendations. You guys always know I'm not a financial advisor, but as you can see here, it's dipped. Its highest point was around $270 a share. $273 a share, currently sitting a price at $232, peaked and dipped, at the lowest point of 185. Nice ETF to pick up when prices are lower if you're looking for that growth and a nice recovery after the recession happens. The second ETF on our list, XLP, the Consumer Staples ETF. This ETF is a little bit of a holding that you'd want to hold during a recession. These are consumer staples that everyone's going to continue to need throughout a recession, and they pay a nice dividend around 2.78%. So you're still collecting that nice cash flow during this recession. And once you move over to the holdings, you'll see why I like this ETF. Move down to the top 10 holdings: Procter & Gamble, Coca-Cola, Pepsi, Walmart, Altria Group, Philip Morris, Costco, Colgate, Kimberly-Clark. These are all household names, and these companies are continue to generate revenue during the recession. During what's going on right now in the world, these companies will still continue to create revenue, continue to earn money, and continue to pay out those dividends consistently over time. So this Consumer Staples ETF is exactly what it's called. Consumer staples, things that people need. They produce essential products to everyone. And these companies will continue to generate money. They may not be the high growth companies that you saw in the Vanguard Technology ETF, but they're going to provide you that stability in your portfolio. If you look at the 5-year chart, a nice slow increase in price. Of course, we had the dip, but it's almost very close to have been fully recovered on the price. So this, going along with the 2.78% dividend, moving over to the dividends tab right here, with a nice solid almost 7% dividend growth rate over the last 5 years. Very nice ETF to add to a portfolio during a recession. Moving over to number 3 on the list, the third ETF that you can add on is, of course, I'm a dividend growth investor. I'm a big fan of dividend ETFs. So we have SPHD, S&P 500 High Dividend Low Volatility ETF. So of course, this ETF, it says low volatility, and that's what a lot of people like and a lot of people look for during recessions when the market are extremely volatile and they may see huge dips in the market. People like to jump to an ETF that has that low volatility option to maybe ease some emotions, make their portfolio not drop in value as much as the overall market, and try to secure and save some capital. So this comes with a very high 5.67% yield. Very nice, very high dividend yield ETF. And of course, this is the S&P 500 high dividend yield ETF. So these are all S&P 500 companies, the 500 largest companies on the American Stock Exchange. And these are very solid companies who are most likely going to survive and continue to create revenue and pay dividends moving forward. Of course, we're going to jump over to the holdings. And as you can see here, very high ETF across a bunch of different sectors. About 6 to 8 different sectors have a significant portion within this ETF. Look at the pie chart here. You can see a lot of pies with equal weights. Moving down, of course, so as you see some familiar names from the consumer staples ETF like Altria, like Philip Morris. Then we see a lot of other players. We see a lot of the high dividend players in here. So AT&T, Dominion Energy, Progressive Corp, General Mills. So these are the companies that pay higher dividends compared to the low consumer staples companies who may have paid lower dividends but offer better growth over time. This is the ETF you need if you need consistent cash flow right now. If you want that low volatility option and you want dividends coming in and you want that cash flow to help boost your portfolio, as you can see here, it has a very nice 5.67% yield with a very nice almost 11% 5-year growth ratio that is extremely high, but again, only 2 years of dividend growth. But once again, if we move over to the 5-year chart and price, same as we've seen with all the other ETFs. The S&P 500 grew rapidly over the past 5 years. These are S&P 500 companies. Of course, you see that nice upward trend. And these holdings provide you a large amount of monthly income because once again, this is a monthly paying ETF. So you can consistently get that cash flow coming in every single month, which may be nice to have during a recession where cash might be a little tight. So having those dividends coming in each and every month may make this a very nice part of your portfolio. Number 4, we have to talk about it, is when the markets drop, people choose to go to bonds. That's everyone's choice. Some people believe in having a lot of bonds in their portfolio. Some believe in having a set allocation, whether it's 60-40, 70-30, 80-20, and having a large part of bonds within their portfolio. Of course, that is up to you. Everyone has their own portfolio allocation needs. So of course, I really want to throw this one in there, ticker symbol BND. This is Vanguard's Total Bond Market ETF. Of course, bonds, like I said, people love them or they hate them. I really like this ETF because it offers a very low 0.04% expense ratio, so it's going to be pennies on the dollar, and of course a nice 2.57% dividend yield. A 2.6 dividend yield is basically exactly what you're looking for within a bond ETF. You can see that the price has grown a decent amount over the past 1 year because I'm sure people have really been looking to add bonds to their portfolio, trying to make their portfolio a little bit safer or have a little less risk within their portfolio. And that's why that might have caused this increase. If we go to the 10-year chart here, you can see exactly what a bond ETF should look like essentially. Essentially, a bond ETF, you want the performance to be somewhat flat over the long period of time because bonds, you collect the same principal over time. The principal doesn't change like dividends. So you want that consistent cash flow coming in. And on average, you're going to see here, like if we look at from 2010, $82 a share, all the way back to 2019, back at $82 a share. So of course, there are some fluctuations like everything throughout the market throughout years, but you can see that the price stays about average consistency across that time, which is what people looking for bonds are really looking to do. These are the people who just want to preserve capital right now, who don't want to see a lot of their capital get lost in the market, and then want to collect that nice 2.6%. Once again, monthly payout. So every single month, they're going to see that money coming in, that interest coming in into their portfolio each and every month. And during a recession, when cash may be hard to accumulate, this might be a nice holding into your portfolio. And the last one, I really want to throw this in there, gold. GLD, ticker symbol, SPDR Gold Trust ETF. So I personally do not invest in gold. but a lot of people really like to make this a staple in their portfolio. Like I said, similar to bonds, it's a preservation of wealth. They really want to hold gold just to ensure their capital is safe throughout the future. And during all this times of uncertainty, we have seen the price of gold shoot up on the 1-year chart. Gold has been a staple for investors throughout history, whether it's physical gold or now there's gold ETFs and gold stocks. It's a very strong staple that I really want to throw in here, because although I don't do it personally, you have to understand what a lot of people like to do during recessions and during market downturn. People really like to have that certainty in there. And if we move over to the 5-year chart, you can see slow, steady increase. That's what happens with gold over the long period of time. Like I said, just a preservation of wealth. This is a very large ETF with $54 billion in assets under management. And of course, it can become a staple into anyone's portfolio if they so choose. And to wrap up the video, those are the 5 different ETFs you could pick up during a market downturn or throughout a recession. Of course, we had the technology ETF, where you're going to really hope for a nice recovery with a lot of these solid companies like Apple, Microsoft, and could lead to a lot of future growth. We saw the consumer staples ETF with a lot of those essential companies that are continuing to generate revenue throughout a recession no matter what. Moving on, we saw the S&P 500 low volatility high dividend ETF that of course creates that nice high monthly cash flow with a nice 5.6% dividend yield that pays out each and every month with that nice low volatility option within there. And of course, those are built up of S&P 500 companies, so you know they're some of the largest companies in America and throughout the world. Then we move on to bonds. Bonds have become a very strong allocation of people's portfolio during a recession. So of course we threw B and D in there, Vanguard's total bond market ETF, paying a consistent 2.6% monthly dividend yield. Very nice to have in a time of uncertainty. And of course, we're going to wrap it up with number 5, the Gold Trust ETF, where people love to have gold in their portfolios. It has been a preservation of wealth throughout time. And of course, during times of uncertainty, people are looking for something that will hold their capital very nicely. So we're going to wrap it up here by jumping right back into the portfolio, where I say, thank you everyone for tuning in. As you can tell, for the 10 minutes throughout this video, my portfolio has actually increased, and we started the video at around $400 up on the daily gain. Now we're at $575 up on the day. So portfolio is performing nicely today. Really look forward to seeing it perform throughout the next 1, 5, 10 plus years. And as always, I'm the Gen Z investor. If you enjoyed this video, please like and subscribe. I'll look for you in the next one. Thanks.